Welcome back, guys. In today's video, we're going to go over position sizing, so how much to put on a trade and how that can help you avoid unnecessary risk. So a major key to trading is to accept that losses will occur, because this is the nature of any competition. Losses will happen to the best of the best. It's just part of it. But the key is to limit the effects of these losses and what they can do to your trading account and to your psyche over time. In trading, this means limiting the amount of loss we can incur per trade. At any time, your trading strategy might call out 5 losing trades in a row. 5, 10, I mean, probably not 10, but you will have consecutive losses in a row. They might be followed by 10 winners, but those losses, if you're risking too much money, can take your trading account down to almost nothing, and your confidence might be shot after that. So it's hard to come to the market with a clear head once you've blown a trading account. I mean, it may happen to you. It happened to me when I first started. It did. But now I look at it and I look at the lessons I've learned from it, and it's the best thing that ever happened to me. But I don't want it to happen to you guys. Before you can manage any type of risk, you have to know how much you can put on each trade. And in order to determine this, we must come into a trade with the mindset of how much can I afford to lose on this trade. And this is one thing that a lot of beginning traders get caught up in. They look at what kind of profit they can gain from a position. The professional trader looks at the amount that could be lost on a trade before entering, and they're comfortable with that loss before they enter a position. So you have working strategies and knowledge of the market at this point. So you can manage the randomly distributed losses that happen in trading. And that's really the only thing we can do as traders, is have a strategy, know how it works, accept that there are losses, and manage our money according to that. And the best way to manage a trade is really to use a stop loss. And I know we've gone over stop losses earlier in the course, but just to refresh, a stop loss is an order that you place when you enter a trade, so that if the trade moves against you and reaches a predetermined level that you set before entering a trade, it will take you out of that trade. So as the name indicates, a stop loss is designed to stop any loss after a certain point. So the key to this is to have the winners obviously run and take off, but also to manage the losses. So you take small calculated losses instead of these huge losses that can take your account out. So even if you're the type of trader where you're looking at your computer and watching your trade, price can move violently for any reason at any time. So you might not be able, even if you're looking at your computer, you might not be able to react fast enough, and you still might have a huge loss on your hands. So this is why a stop loss is so critical, because anything can happen, and you have to respect that before you start trading. So position sizing or trading size is just a fancy way to say how much should I put on this trade. So to determine that, we use a stop loss placement, and we determine the risk that we want to put on that trade, and then we figure out the size of our position based on that, based on our stop loss. So in general, while starting out, you'd never want to risk more than 1% of your account on any given trade. And the reason for this is because of a concept called the random distribution of probable outcomes. So let's say on average you trade and you have a 70% strike rate, meaning you hit 7 out of 10 trades. You're a 70% trader. You expect to hit 7 out of 10, but the reality is in 1 month you might go 3 out of 10, but the next month you go 10 out of 10. So over the long run, your trading account and your trading performance is going to balance out. But what if in that first month, when you lost 7 trades, you were risking 10% on each trade? I mean, your account is going to be nearly blown. Your account is going to be, about 30% of what it was. So probabilities work out randomly in all areas of life. So let's say you were flipping a coin 10 times. You might get, you expect it to be 50-50. And if you do it enough, it will turn out to be 50-50. But with any 10 flip sequence, you might have 7 heads and 3 tails, or 2 tails and 8 heads. You don't know how they're going to play out on a sequence by sequence basis. So just really, there's hot and cold streaks. That's really the most important thing to understand, is that you want to make money on the hot streaks. And if you do hit a cold patch, you don't want that to take out your whole entire trading account, because it's going to take a long time to build that back up. So it's just like any other business. There's going to be slumps here and there, but risk management and properly positioning yourself is going to help you not suffer too badly from the cold streaks. So how do you apply all this? Well, what you need to know in order to risk a certain percentage is, how many pips is my stop loss? How much is each pip worth? And how much each pip worth depends on your position size, or how much you place on a trade. So if you have $1,000 and you only want to risk $10 to be in that 1% range, you might have a move that's marked up and you have a 50 pip stop loss. Well, you need to place a trade that equals out so that each pip is worth 20 cents, because 20 cents times 50 pips equals $10. Now, for each pair, the pip sizes vary slightly. So what we've done is we've attached some resources below this lesson to help you know how much to put on each trade and what the value of each pip is worth on each pair. So it's a lot easier than it sounds, really, because a lot of broker platforms will show you this before you enter a trade. And if not, there's a lot of different apps out there available that can help you. And we'll add links to that below as well.